Cam, have you noticed that everything today is driven by money?
Yes, indeed. It's good.
Good.
The point is, Dr. Duck, is that greed, for lack of a better word, is good.
Greed?
Greed is right.
Right.
Greed works.
It does?
Greed clarifies, cuts through, and captures the essence of the evolutionary spirit.
I see.
Greed in all of its forms, greed for life, for money, for love, knowledge, has marked the upward surge of mankind.
Uh, isn't it technically now humankind?
And greed, you mark my words, will not only save today's podcast, but that other malfunctioning corporation called It's About Nothing.
Welcome to It's About Nothing, now only $9.95. All right, Cam. Just before we started today, you did say that this script has a connection to your childhood.
It does, and
That's a
it still managed to
bit
be
disturbing,
cheesy.
isn't it?
Um, yeah, because it is disturbing because obviously I'm an '80s kid, '90s kid, but I grew up in that era where the movie Wall Street was big, and my dad being a businessman and an investor in the markets and all that, and someone who survived the 1987 crash and all that kind of thing. He had me watching the movie Wall Street when I was really quite young. I think definitely a preteen, and sort of taught me in a warped way to admire this character of Gordon Gekko. So I'd go around like as a little kid, slicking back the hair that I had in those days and reciting the greed is good speech. Of course, we know at the end of that movie, Gecko becomes undone, and the whole mantra of greed is good. He does get his comeuppance, but I used to love that speech as a child.
I thought you were going to tell me that your mother read it to you when you went to bed at night. Read the script of Wall Street.
I hope not.
So he's. Do you know? It's funny. I've seen that monologue probably on YouTube, and I know the film quite well. Charlie Sheen's in it as well, isn't he?
Yeah, he is. Yeah, young Charlie Sheen.
But I don't think I've ever seen it, to be honest. And
Martin Sheen is also in that movie. Sorry to
who is?
jump in. Martin Sheen, Charlie Sheen's father, Martin, actually plays his father in that movie.
Oh, okay. Don't you mean Martin Estevez?
No,
No,
no.
that's his mother's maiden name, isn't it? Or is that Martin Sheen's original name, Estevez? Do you remember? Because you
Is
know
it?
how
Oh, I don't know. Now you're sort of going off into areas I'm unsure of. Yeah.
well, Emilio Estevez is his son as well.
Okay. Is that one from another marriage or something?
No,
Right.
I'm not sure. We'll have to. This is
Oh,
why we need
okay.
we need an assistant person who can Google for us. But
We do. We do.
I thought Martin Sheen's uh, real name is Martin Estevez, and his stage name is Martin Sheen.
I didn't
And
know.
Charlie Sheen took his dad's name, and
Right.
Emilio Estevez took the original family name.
I had no idea. So now I have to. I'm going to be like bugged by this for the rest of the day. So I'll have to go check this out.
Yeah, it's either that or Emilio Estevez's mother was Estevez, but I don't think so for some reason. But that's what I understand. But anyway, you actually ruined the movie for me. But although I can imagine that's probably the only trajectory that film could go in if you have a character like that they'll have their comeuppance at the end.
Wait, are you saying you haven't seen Wall Street?
No, I haven't seen it, and
Oh
I
wow.
like to
And
keep
you're such
myself.
like a movie buff, and that's a real.
Yeah, I know it's terrible, isn't it?
I'm surprised. Yeah, there's Wall Street 2 as well.
Yes.
Which I don't want to spoil for you, but you must know at least that Gordon Gekko doesn't die because he shows up in Wall Street 2.
Yeah. Well, is Wall Street ultimately an anti-capitalist movie, or is it not really? It's somewhere it's a bit grayer than that.
Uh, I suppose it. I suppose it is an anti excesses of capitalism movie. Is it an Oliver Stone? I'm trying to remember who.
Yeah, it is.
Well, if it's an Oliver Stone, then I'm guessing it is an anti-capitalist movie because
Yeah.
he's an out and out Marxist. We all
Oh, is he?
so yeah, so it is, and like it was, it's set in New York in that era when you know too much was never enough, and it's all about cocaine and fast cars and making a lot of money in a hurry, and
Mhm.
it's a morality tale at the end of the day.
Yes. Oh, and I suppose inspired I know that this is based on a true story, but there's the Wolf of Wall Street, which is
Yeah.
based on an actual story. But it's
Yeah.
probably not a coincidence that it's called the Wolf of Wall Street. That it probably conjures up the Wall Street movie as well. That kind of the same
Yeah.
sort of thing. Basically, it's the same thing, isn't it? Really, about someone who
Yeah, they're similar because I think like Wall Street set around that time of the '87 crash, and then Wolf of Wall Street's kind of set around that time of the GFC, isn't it? And sort of what happened to Wall Street then. So the themes are similar. Yeah.
Yeah. Well, the only reason this popped into my head today, and we're not inviting a person on today who is anything like the Gordon Gekko character. I'll just I'll put James's mind at ease that the intention wasn't to discuss the dodgy practices of people who get involved in the share market. But it was just the first movie that popped into my head when I thought of finance for some reason. So if anything, the reference to Wall Street is more of a projective test for me. I think that the first thing that pops into my head when I think of finance is the Gordon Gekko character. But our guest today is James Wrigley, and I came across James in a, I don't know, maybe it's now it's become a more traditional way of coming across people, but it's through LinkedIn. And James was doing some really interesting videos. I'm not even sure how I originally came across them, but I thought, oh, they were quite interesting. Like they kind of drew me in. I was looking at them on my phone, and I thought, oh, and then when they popped up, I thought, oh, I'll listen to this again. And I was quite curious for a couple of reasons. One, the topics interest me, but also I was curious about the nature of podcasting, live streaming, and it's become much more common for individuals now to really go out and provide lots of free content to start a discussion and to also, I guess, build a network and build a brand. And there's a bit of an art to it. And some people have some fantastic content, but no one's interested in listening to it. And then there are other people who get listened to all the time and haven't got very interesting things at all. And then there's people who kind of hit the sweet spot where they've got some really great things to say and they take off and they're quite popular. And I thought there's two things I thought would be great to discuss with James today. One being the topics of financial advice and doing financial planning. And the second one might be to talk a bit about his video streaming and podcasting experience. So I might bring James in now, and I'll just flick the switch, and no, I won't. Oh, sorry. Yep, there we go. G'day, James. Welcome to It's About Nothing.
Hi, Nick. Hi, Cam. Thank you for having me on. Thank you for inviting me along. Pleasure. I have the answer to your question that you were talking about before. I Googled it whilst you were talking.
Oh,
yeah.
Resourceful man.
So it's Ramon Antonio Gerardo Estevez.
Oh, wow.
Really? Machine's real name.
Wow.
Completely messed up the pronunciation, but
it
gets the point nonetheless.
So he's a Latino man. I did not realize that.
Thank you for having me.
It's such a wonderful name as well, isn't it? It's such a shame to be called Martin Sheen after you've got such a fantastic sounding name. You know, like lots of alliteration and syllables. Yeah.
Sure is.
Yeah,
there sure is.
It's funny. Like I was listening to something Arnold Schwarzenegger interview the other day, and as you can imagine, when he came to America, basically everyone said to him, there were three reasons why you'll never work in Hollywood. One is your name is terrible. No one will ever be able to say it, which now everyone knows it, of course. The other reason was his accent, of course. He said, you can't speak like an American, so no one's ever going to, you're never going to star in a Western or anything like that. And can you guess what the third reason was?
His physique, maybe?
Yeah, exactly.
Yeah.
They said, you're way too big. You do not, you simply would not be able to start. And this is during an era just before the big influx of these big action movies where actors were a bit more serious. There was more dramas.
Yes.
Yeah.
And
I remember his early stuff. He used to do sort of like guest appearances on TV shows at the time, like going right back to like the Lucille Ball show, I think, as a bodybuilder though.
Yeah.
So not sort of playing roles initially. So I can't remember what his breakthrough was. It was obviously before Terminator, wasn't it?
Yeah, it was Conan the Barbarian.
Yeah, there you go.
Right,
Which is obviously a big physical.
Yes.
You need the big muscles and bashing and crashing stuff.
Yeah, well, they said to him when they hired him for that role, they actually said to him, if you didn't exist, Arnold, we would have to build one of you. And he basically realized then that it was that his body had now become an asset to him. And then when he did Terminator, James Cameron said to him, I don't think the film would have worked if you had a normal American accent. It was something about the accent that really made the Terminator distinctive.
Yeah.
So he felt, and then he was sort of validated on his accent being an asset as well.
Yeah. When I worked in politics, Matthias Cormann, who was the finance minister until fairly recently. I worked in another office sort of to his, but we used to note internally that he has a Belgian German sort of accent, but it was like somewhat similar to Schwarzenegger's accent. So we were always like gently encouraging him to kind of play. And he kind of resisted it a bit, and then he'd do it a little bit around. He'd say things like "I'll be back" and stuff. But then at one point in an election campaign, he went out and said, "Bill Shorten is an economic girly man." Like that, it played really well in some quarters, and then obviously really badly.
That's right.
In other quarters, yeah.
Now, James, just out of interest, so I noticed on your profile you talked about you had a love of numbers from a very young age.
Yeah.
Which contrasts many people's experience. And I'm just thinking about my daughters right now who, when they have a maths problem in front of them, they find the whole thing to be so frustrating. And certainly my background is I've always been a much better in the English and the humanities type of subjects.
Yep.
Yeah.
My parents as well. Is this something that's run in the family with you, or is it something unique to you?
Look, to a degree, it runs in the family. Like, mum and dad aren't mathematicians or anything like that, but they got the basic maths, and they could help me to a point up until probably mid high school. They could help me thereafter. But I think it was more just getting the right support, especially in the school environment. It kind of goes back to grade one. I can't remember my grade one teacher, but I can just remember some events we had. There was a maths test of sorts, back in grade one, and it was probably like 1 + 1, and you had to write = 2. There would have been 10 questions, pretty simple stuff. It was back in grade one, and I was the only kid in the class that got all the questions right. And I remember all the kids leaving the class, and the teacher gave me 20 cents as a reward for getting all the questions right. And I went off to the canteen and bought myself a Zupa Duper with the 20 cents. And I think it's just that positive reinforcement at a really young age that I just convinced myself, oh, you know what, I can do this. And so whether I could or I couldn't, I'd been told at a young age, actually, you can do this and you're good at it. And then that's just stuck with me thereafter. So I just had this thing in my head that I could do it. And I did a lot of the maths and science subjects through school, and they came relatively easy to me. Just some people are more maths and science, and some people are more arts and humanities and whatever else there might be. Yeah.
Yeah, because when I was studying psychology, a personality lecturer, he was a really interesting guy. He had these fantastic stories, but he used to say that most of the time where you end up in your career was influenced by your parents, even if your parents didn't explicitly say it, they influenced you in a way that might have even just been they were more proud of you, for example, for doing better in something, or just receiving a pat on the back for something which they indirectly kind of support or endorse.
Yeah.
And I just wonder that maybe these little reinforcing experiences, what you're talking about, those memories especially when you're younger, and you draw that connection with something that's positive to you, can really drive your interests.
Yeah, I think that's exactly it. And then I talk about the bit that you referenced on my LinkedIn profile. I talk about in later in high school, before we got into like the more complicated maths subjects. It was kind of around year 9, year 10, when everyone was still doing a general level of maths. I could do it all pretty easily, and I used to write myself cheat sheets, and then I'd almost like my friends at school. Would have there'd be a maths test after lunch, and so we'd kind of spend the lunchtime. I'd be helping them, answering some questions and things, and that was a bit more positive reinforcement as well. Like you kind of had this people around and made you feel good. Oh yeah, I'm helping these people, and they're actually getting something from it. And then that's then kind of transposed into what I actually do as a job. You're meeting with people, you're helping them make some progress and some change, and it's a good feeling. So it's that positive reinforcement, and it's just gone from there.
Yeah.
One of the things I find interesting, because when we do psychology, we do like lots of like statistics, and for some reason, and I don't know if you've got any insight into this, I'm very good at statistics, but not particularly good at just some of the more basic maths. Like I'll find that I make silly mistakes in adding things up and calculating things, but I'm okay at looking at patterns and trends and doing those inferential type statistics. And do you find that you can do both those things, or are you better at doing more of the non-statistical stuff?
Yeah, I reckon I'm the other way around. So through university, there was a range of statistics subjects that I had to do, and I had to work pretty hard at them. They didn't come easily to me. So yes, I reckon I was probably the opposite. So like I did maths methods and specialist mathematics through high school in years 11 and 12, and that type of stuff came pretty easily. That's probably more engineering type mathematics that might fall out of that. Whereas in financial, the financial world, it's all about standard deviations and correlations and all of this type of stuff. Calculating that through university, it took a fair bit of work. That didn't come easily to me, no.
Now I can recall, so James, Cam and I went to school together many years ago now, sadly, and I'm pretty sure, Cam, you were in my class, my year 11 maths class.
Yes,
I think you were, and I seem to recall that we were probably both struggling quite a bit.
I know I was.
Yeah, well, I certainly was, and I used to sit there and the teacher used to get so frustrated. So the opposite to your experience, James. So you got the 20 cents and the icy pole. This teacher used to throw the texters at the back of the wall out of frustration.
Yeah. Yes.
So my memories of those classes were usually one of just put your head down and hope for the best.
Yeah, that was my experience as well. And I was just thinking now to how I kind of relate to numbers and that in my day-to-day life. And I've had to learn how to read budgets and things like that. So I can do that after, sort of years of practice and honing and probably like stats to some extent too in research I've done. So for me, it's probably working out what I functionally need to do. But then I was hanging out with some younger cousins of mine recently and doing they asked me to quiz them with timetables, and I was sort of doing that, and that was fun. And then I had to sort of think for a second as I was like going through it with them to check whether their answers were right. And I thought, wow, I'm really rusty on this. And I can remember doing it like rote learning it as we all used to back in those days, but I just haven't had to call on those skills for like 20 years or whatever it would be.
Well, it's not reading profit and loss statements and budgets and things like that, and managing your own personal finances. That's generally not taught through the school.
Yeah.
Unless you go and do some accounting subjects, you'll get a bit of exposure to that. But just generally dealing with numbers and the real life practicalities of it, it's all about learning your 11 times tables. Is that really useful? Everyone just pulls out their phone and puts to their phone to get the answer.
Is that part of the problem though, James? Like we don't really teach people how to read budgets, and like I'd argue that most people at some point in their lives are going to need to be able to do that, even if it's organizing their own household budget, or they're running their own small business. Like I know tradies, for example, who have to budget, just for their own little contracting business that they're running, and people, working in big companies, NGOs, whatever, like even if they're not preparing a budget, in order to like contribute to a meeting, they have to be able to read someone else's work and make sense of it, right?
Yeah, that's it. And we're not taught it. And so big problem that I see with people that come in and see me, that different ages and stages of life, but there's this kind of misconception out there that if I just earn a little bit more money, then it's going to be okay. But it's really not. The more you earn, the bigger the problem is. So if you can't manage on your $40,000 or $50,000 a year that you might be earning straight out of uni, as your career progresses and that number becomes 3 or 4 or 500,000, depending on where people end up and what they end up doing, the mess just gets bigger. It's because we're not taught how to deal with it. Just some practical steps as to make life a little bit easier. Just because there's more money coming in doesn't solve a problem.
Well, incomings and outgoings is obviously the other side of that. I do remember doing commerce, I think in year 10 or 11, and we probably did some basics, but one thing that stuck with me was the difference between wants and needs. And I have to admit, I have not always followed that sort of maxim in my lifestyle or my purchases, but
very few people do.
Yeah, but it's always been there in the back of my head, like, is this a want or is this a need?
Yeah.
James, so out of interest, let's just talk a little bit about the sort of advice and the services that you generally provide people. So you want to talk a bit sort of broadly about what those things are?
Yeah. So it's all, so I guess the clients generally sit in one of two categories. Ultimately, a lot of the work that we do is helping people transition through to retirement, but retirement means different things to different people at different ages. And for someone that I'm engaging with, I'm preparing some advice for someone that's in their early 30s at the moment. They've got a whole lot of life to leave ahead of them before that kind of traditional retirement age. More and more, we're seeing higher income, younger people aspiring to be at some point, maybe in their mid 40s, early 50s, where they have the option to actually call it quits on the 9 to 5 and not have to be continually showing up to work to earn a paycheck. So looking to do some things there. And then, so there's probably a third of my clients are in that younger or to meet kind of a younger age bracket between maybe 35 and 50. And then probably 2/3 of the clients that I work with are 60 plus, maybe in those last couple of years of counting down to which they're actually going to retire. I had a meeting with a client yesterday where they've decided they're going to retire in July, 1st of July, they're going to retire. So a lot of work in and around preparing for that and then transitioning through to full retirement. So I guess that the type of advice and the type of work differs between those two. The older people that are in those last couple of years of retirement, it's really just trying to make best use of what they've already got. So they might have some money in super, they might have bought an investment property, they might have some cash in the bank, who knows, some inheritance might come along. There's not a lot of forward planning that you can actually do for those people. There's only a few years worth of working life ahead of them. There's only so much you can do. But a lot of the work that we do is around rationalizing and making best use of whatever you might have been able to accumulate up until this stage, so that's then set up appropriately to support you for your next stage of life, versus someone in their mid 30s or 40s. They've got a fair bit of time ahead of them, and so you can start to make some small changes and encourage some small changes in their behavior and what they're doing, and this whole needs and wants thing that you mentioned. Just helping them, educate them is probably the big piece in that space. Educate them to what little changes you might be able to do now that have a much bigger impact in time. And so there's some changes there, but they've got mortgages and they've got kids and they've got holidays they want to go on and career progression and moving into running their own business or going the other way. So there's a lot going on in those younger people's lives.
Yeah, so that's a kind of an interesting dilemma that you've got there, isn't it? Because the ones who are most likely to be motivated highly motivated to speak to you are the ones who are nearing retirement in some ways, who have got fewer levers they can use.
Yes.
And then the ones who are like in their late 20s, early 30s, the ones you come to see, that's great timing. But there's so many people who are in their early 30s who will be thinking, oh God, I've got so much time on my hands. Why am I bothering? I'm just going to pay off my mortgage and just do that, right? And
Yep.
would it be correct to say though, like I know it's very hard to provide general advice. You need to look at individuals.
Yeah.
But I've heard certainly that if you do have a mortgage, a lot of people say debt reduction is your best strategy when you're younger. Just get your debt right down and don't worry too much about trying to play the stock market and other things. Just get your debt down.
Yep.
Is that a good general rule, or do you think no, Nick? It really depends on the circumstance. You can't just wrap it all up in one rule.
Look, I guess it always depends on individual circumstances, but the biggest asset that younger person has is actually time ahead of them.
Mm-hmm.
So a little bit for a long time. When I say a little bit, a little bit of saving, a little bit of investing, a little bit of topping up your super, whatever it might be, depending on what's appropriate for that person. But a little bit for a long time means you need to take a whole lot less risk with your investing. You have the beauty of compounding, and we're talking about maths and statistics and all the rest of it. You get one of these curves that just a small amount compounding for the first 5-10 years, it looks like nothing, but all of the activity is out here as that compounding takes hold. And if you're doing that now in your 20s or 30s or however old someone might be, it's not until in the 50s and 60s when you actually see the benefits of what you've done back then. So if all someone does is just concentrate on paying down their mortgage, and they pay off their mortgage over 15 years or something, that's fantastic. They've paid off their mortgage over 15 years, but they've also lost 15 years worth of opportunity to do something else as well. And so typically my advice to people in that space is to do a little bit of both. Pay a little bit more off your mortgage, but at the same time, try and do something else at the same time. People often look at to say, well, I'll earn, my super fund's been averaging 7% a year over here. My mortgage is only costing me 3 or 4, low 2s or 3% over here. So from an interest or return point of view, there's a difference, but nothing's ever guaranteed. So you can't just look at it like that. I encourage doing a bit of both.
And just if I were to look at two different types of people broadly, so like in psychological research shows that there are some people who are generally kind of more promotion focused, so they're more focused on aspirations, benefits, and gains.
Mm-hmm.
And there's a group of people who are much more prevention focused. They're very loss averse.
Mm-hmm.
So if something bad happens to them, or if they lose money, they'll feel much more pain. They'll feel much more pain than someone who's more promotion focused. But people who are promotion focused tend to feel they've got a greater sensitivity to reward. So they really love the feeling of making money or being successful, and don't worry as much about losing. They're much more focused on that. Mm-hmm. Do you find that you do get those sorts of people that some who are just really not really focused on the detail and take a few more risks, and then others who painfully want to go over every detail and are worried about every dollar that might have been lost in the year? Do you get that kind of profile?
Yeah, you do. So everyone's unique in one way, shape, or form, and because that's just through the relationship building exercise that we go through with clients. So even before so like I said, the financial advice industry is a heavily regulated industry. There's all of these checks and balances and things that we need to do. For most clients, ultimately, we need to deliver them what's called a statement of advice, so written document that says, do 1, 2, 3, and 4, and this is all the risks and things associated. It's quite a lengthy document, but there's a series of meetings that goes on before that. To just a lot of that is the building the relationship, but just trying to understand where they are on that spectrum that you just articulated, and then so when it gets to these people becoming clients, some of them are incredibly detailed and want all of the numbers and all of the far beyond what we even have in our standard advice documents. So there's other projections and other supporting documents and all of this other stuff that needs to go in. And then there's others that just want to know that they're working with someone that has their best interests at heart, obviously, but is there to kind of coach them and help them and guide them along the way, isn't too concerned in the granular detail. It's just about managing personalities. There's still certain documents we have to disclose and certain things that we have to provide regardless of what that personality looks like. But it's the level of detail that I might go into in explaining something to someone will differ based on their personalities, for sure.
Are you finding that people's investment behavior sort of changed over the last year with COVID and like that impact on the economy, or is it something you can quantify?
So the general public, yes. The clients that I work with, no. A lot of the clients that I work with, I've been working with for many, many, many years. And so we're always talking about preparing for the unexpected. So at some point, something's going to happen, and we need to make sure that there's provisions in place to allow you to continue living whatever life you're living right now, right through that. And so for all of those clients that I've been working with for many years up until events of last year, aside from two, they all just sailed through that without a drama. We certainly increased our messaging and our communication, recording videos and all the rest of it to reassure people, but everyone just stayed on the journey, really. Then I had, looking at LinkedIn in particular, we were talking about before, I had a lot of young people in particular reaching out to me saying they'd seen what happened during the GFC, but they were too young, they didn't have any money.
Yep.
They've now seen this big drop and they're saying, look, I think this is a big opportunity for me to do something here.
Right.
And so a lot of new people seeking out advice, and there's a lot of the ComSecs of the world and these other really simple general public, I guess, share trading platforms, all the ones in America, the Robin Hoods and the like. We just had this convergence of technology that made investing easy for everyone at a time when we had this massive drop in markets. So there was a huge increase. This is just across the world, a huge increase in everyday retail investors just getting involved with share markets, which I think had a lot to do with why things turned around quite so quickly, because there was all of these first-time investors just saying, "Oh, I'm going to get in," and they're having a bit of a punt. But
yeah, James, that was actually something I wanted to ask you, and I think you've answered it, which is it's almost remarkable that the economy isn't worse off because there was a lot of doom and gloom.
Yep.
And that you've explained at least one factor, which is quite interesting. It's the idea that, and I must admit, I was thinking the same way when you described that situation. I lived through the GFC as well, but similar to what you were saying, like I didn't have any investment. I didn't have a property. I just had my job, and it didn't have a huge impact on me.
Yep.
But when this happened, one of my first thoughts was, oh, well, there's opportunity here as well. And should I be thinking about that? And I'm running my own business, but I didn't really maybe give it enough thought or time. But I hadn't sort of anticipated that one of the ways that the downturn was buffered was all the opportunists coming in and really in doing more investment as in a response. And not a lot of people were talking about that at the start. I didn't hear much of that at all.
Yeah, no, I don't know that it got much airplay, but yeah, there was certainly various things that I've read over the time. There was a lot of first-time investors getting involved, and just anecdotally, I had a lot of people seeking out advice from me. I guess very few went through with advice, and so I had one client in particular that a lady in her probably in her mid-60s that actually sought out advice, paid for it, and all the rest of it, but just when it came to crunch time to actually doing something, it was just all too scary for her and didn't do it.
Yeah.
Looking back on a missed opportunity, but no one was to know that it was going to turn around as quickly as it did.
Yeah, I was going to ask actually, because last year I was sort of halfway through last year, I was saying to people, I really wish I'd bought shares in Zoom or Perspex or something, because I saw something Perspex screens were going up everywhere. Like, did you have people kind of coming to you, not necessarily with those ideas, but sort of seeing, the world being shaken up and willing to take more risk because they saw opportunities?
Yeah, definitely. And so it was those that have those that were in steady employment and weren't really worried about losing their job. And so and then we had this, everyone stuck at home, couldn't do anything, couldn't travel. So everyone saved a whole lot of money last year as well. So stable employment saved a whole lot of money. At the same time, share markets tumbled. And so a lot of people got involved with that. A lot of people also didn't. The thing that I've recorded a few videos and made a few posts about on my LinkedIn profile is that for anyone that has gotten in the last year or so, they've probably made a fair bit of money, and good luck to them. Well done. They took a risk and it's paid off. It could have very easily gone the other way, but it hasn't. Because what people need to realize or appreciate is that earning 20, 25, 30% return in 12 months on your share market investments isn't something that happens year in, year out.
Yeah.
So we've almost got this kind of recency bias where first-time investors have seen these massive returns. We get back to where we are, and then next year they're disappointed when they don't earn 20 or 25% from the share market.
So do people really expect that to continue? Like, even though I'm sure you're sort of telling them how it works long term, but do they just get hooked on it, so to speak?
So people that I'm talking to, part of the ongoing communications and meetings I have with them, I'm pretty confident they're all across that and expecting that. It's more just these unadvised first-time investors that have had a good win. Good luck to them. They've made a bit of money. It's then what happens from here. Our conversations I'm having with clients at the moment to say, look, I think that the quick wins are behind us. Probably turned around a little bit quicker than what we thought it would. Just history repeating itself. It was always going to recover. The pace at which it recovered may be a little bit quicker than what we thought. But I guess where to from here is a big part of the conversation that we're having.
Yeah.
So James, getting back to like the personalities, right? So it mentioned the people who are promotion focused, prevention focused. I'm curious, do the promotion focused, like people who are more risk takers, and I don't necessarily mean high risk takers. Like high risk taker could be somebody who goes off to the casino and puts all their savings down. That's a whole other thing. But would you say generally, to be successful financially, at least, you have to have a bit of risk taking in your DNA to do that?
It depends how early you start, I guess. Back to this time thing that I was talking about before. The sooner someone does something about trying to make a positive change in their life in general, we're talking about finances, but their life in general, I guess the less of a change they have to do, so long as they just continue repeating that.
Yep.
So you have to be willing to take some level of risk. If you did nothing, all you do is pay off your mortgage and save some money in the bank. Great, it's better than doing nothing.
Yeah.
But if someone was willing to take on a level of risk, and that's a different amount for everyone, chances are the outcome might have been a whole lot different over a long enough period of time.
Yeah. When we were at school, you probably remember this, Cam, that one of the things that certainly reinforced, and I think it's controversial today, that the things like the Dolomites Commonwealth Bank program, where they come to your school, they get you to sign up an account, and they teach you about savings. And I understand, I don't know the details behind this, but I do understand today that they don't allow that to happen anymore because it's a form of getting kids indoctrinated into a particular bank before they're actually adults. And so they've got this account, they leave the school and they've got this account, so they become like, say, Commonwealth Bank members.
It goes back to the era where there was only one bank, of course, but that's history. So back in the day, before our time, but there was basically only one bank. So now I guess it's pushing a certain bank. But I heard recently that they'd been banned from doing this in school.
But you have this, I think in like, you talked about your experience with getting the 20 cents, these early childhood experiences. I think a lot of people, their first experience with money is from either their parents or the bank or some sort of system that teaches them about putting savings away. So tipping away, putting 20 cents away, to $2 away, and if you just and almost it's almost teaching them the I guess the risk averse approach to saving, which is important, saving, but it's like, don't spend all your money, squirrel some of it away for a rainy day. Reduce, don't act on your impulses, and it teaches, and people learn that very well. One thing that isn't taught very well is about what you're referring to, which is more about, we don't have to be going out splurging on shares and trying to make a big 30% jump on those crashes. What you're saying is you make almost like lots of small risks over time and just allow that to happen. And then actually, because it's done over a long period and it's not done impulsively, then over time it'll grow much like a plant will grow over time. You just nurture it a bit. So don't treat it like it's a short-term impulsive thing, but also don't just sit back and squirrel away your money as well, because if you do that, you'll end up with some money in your bank account, but you'll be so far behind everyone else that you'll be kicking yourself that you didn't, make some investments.
Yeah. I think I can remember being taken to shareholder meetings when I was like 12 with my dad because he wanted me to have that sort of experience. So for me, like the idea of owning shares was very, very normal. So I've, something I've done, throughout most of my life. But then that's not normal for everybody, right? No. So a lot of people, they won't, some people will never do it. And it's interesting, like a lot of people kind of don't realize that everyone is a shareholder effectively in this country through their superannuation, right? Like to some extent. And I often see in the media, like sometimes people decrying, the behavior of certain companies and they're, only out for profits and shareholders. And I think, you probably don't realize you might actually be a shareholder in that bank or in that, mining.
I shake my head every time. The national banks, for example. Those greedy banks, they're only in it for the shareholders, but every person in the country is probably a shareholder in those banks.
Effectively is. I have a sort of similar response in a lot of different things I see as well. So I guess that's just an observation. Like, for me, the concept of owning shares, and also I can remember, going into a meeting and seeing how an AGM worked, and that your shareholders were effectively the owners of the company, and the board made recommendations and the shareholders voted and that sort of thing. And I think that's good, to sort of teach investment behavior, that not only do you make money out of this, but you can sort of to some extent have a say in the way that companies run. And we do, I'm not going to exaggerate it, but we do see shareholders exercise influence in the direction of companies, and boards do have to go to that, shareholder group, to sort of get permission. And we also increasingly see people exercise, whether it's ethical investment or what have you, but they kind of direct where they want their money to go, and companies sort of will rise and fall, based on that.
Absolutely. Yeah.
So James, that's so if I sort of go back a bit, it's I think it sounds like overall that there's this element of needing to, I guess, have a long-term strategic view about your savings. Are there now? Whenever I try and imagine all the things you could possibly invest in, I always think, there's so many things you can invest in. And then when I actually try and pin down what those things actually are, I always come up short. I only can ever think of the house you're in or that you want to buy, shares. And then I get to some other things and I go, what exactly else can you invest in these days that will actually grow over time? Is a business?
That's it. And so it's really not that complicated. You've got assets like property, whether that's the house that you live in, you buy an investment property down the road, you buy a factory or a commercial premises of some variety, but you've got property. You can own a business, and so whether it's you own your own business and you're a small business owner and operator, or you own a fraction of a much larger business like the Commonwealth Bank, but nevertheless you're still a business owner. And kind of they're your options. You save some money in the bank. More and more, there's all about crypto and people getting into that. But really, that's just I guess my very limited understanding of it, that's just some other exchange of people valuing something and an agreement between me and you that this thing is worth something. Just like a $5 note, there's an agreement between you and I that this piece of plastic has a value and can be exchanged for something, or a piece of yellow metal that's dug out of the ground that we call gold. There's an agreement between you and I that this can be exchanged for something of other values. So yeah, it's really not. There's really not that many options.
Do you have clients like with assets like art and things like that they're sort of including? I mean, there's probably going to be like at the higher end, obviously, but art, even jewelry, that kind of stuff. I mean, these things can obviously be assets that appreciate over time, or possibly depreciate, I guess.
Yep, they can be. And look, certain people have got that. I've got a particular client that has some old rare cars, old Ferrari and things like that. So they have a value to someone. To someone, it's just a red car. Who cares? And to someone else, it's quite valuable, and they'll pay a whole lot of money for it. There's other more of those collectible type things that people deem have a value in the right circles. People deem they have a value, and people hold them as assets for sure.
And what about cryptocurrency? It's not something I have dabbled in myself. I've got a couple friends who have varying degrees of sort of involvement and success. No sort of extreme stories either way, I suppose. But I've kept out of it myself. What about you? And
yeah, so look, I've kept out of it myself too. I'm just kind of going through a stage at the moment, just trying to educate myself on what is it and what's the appeal, and why would someone want to do this. So I've got some clients that have had a bit of a dabble in it. One client in particular, he's now no longer a client, but put a lot of his wealth into crypto a few years back, and he will have done very well over the last few years, because it's worked out based on his thesis, and he'd spent hours and hours and hours and hours researching and doing all of this stuff. He wasn't one of these people. Instagram's full of people selling courses on how to trade crypto and make all this money and the rest of it. So that's I suspect will trap a few people. There'll be a few people that are caught out that aren't doing their due diligence on it.
Well, they're not studying it. Like, it's interesting you mentioned that, because I can remember, this father who was sort of trying to groom me to be a bit of a Gordon Gekko. I was given one of Warren Buffett's books to read when I was quite young. I'm sure I disappointed my father in this respect too, because I didn't go into the business world, or at least become an investor in a really big way. But one of his rules of investing, I think, is something along the lines of he won't invest in things that he doesn't really understand.
Yeah.
So a lot, he's famous for investing in stuff like, American Express and Coca-Cola and real staples that kind of like stand the test of time. And I'm probably similar in the respect that I've tended to invest, relatively conservatively, but like certainly not in an industry or a product that I just don't understand what the core function of it is and what it actually does and delivers. So yeah, for me, that's probably why I haven't invested in crypto. I mean, I guess I understand the basic concept of what it's supposed to do. It's a currency, but there's so many unknowns behind it for me.
Yeah, and so we're the same. Any recommendations that we're making to clients, it's somewhat boring type of investments. They've been around for a long time, and they're not. There's none of this speculative stuff. We're not buying something because we think it's going to go up 30% in the next 2 weeks. We're buying assets that the businesses that have stood the test of time and we think are going to be here for another 20 years. And so we're buying those, averaging into them small amounts over time for these younger clients that are building up. And it works.
Yeah, Cam, I think my dad's got that philosophy. He's got some shares, and his view is that he invests in things that he likes himself. So things like JB Hi-Fi and things that he can imagine that people need and want. And and also to avoid investing in overseas businesses, because you just, as much as you try, unless you make it your full-time job, you won't be able to keep your pulse on what's really happening. There is certainly a concern as well, wouldn't there be, James, especially with investments, that you there'll always be someone who knows a bit more about, say, a company and how it's doing than you will. So there'd be insider stuff happening all the time as well, and so it isn't always. It always sounds to me that the idea of say shares can be very profitable for people, but it's a lot of uncertainty about. It seems so. I guess so dynamic and can be manipulated so easily. I can imagine many people would prefer to invest in, say, property, something they can physically see and understand, than something that can crash, that can be where people can mess around with the system to make the stock market go up and down, and it seems to be more volatile, I guess, is what I'm saying.
Yeah, I guess we're just generally more comfortable with property, and so most people will have grown up in a house, and then we're told to go and buy a house, and you get mum and dad and aunties and uncles and grandparents. Have you bought a house yet? Have you bought a house yet? So that's just ingrained in us, and then
that's a cultural thing in Australia.
It's a cultural thing, yeah.
Europe's not like that so much. For example.
And so we're comfortable with this idea of buying a property. Great, I'm all for it. Then it's about when people get to a particular level in amongst friendship circles and things, it's starting to buy investment properties, and so people are comfortable with that idea because property is just so ingrained in us. And then this share market over here is seen as this big bad scary world, and it's really because we haven't spent the time to learn about it. It hasn't been taught to us terribly much. There's not that upbringing in our households around it. So, one or the other, they have their pros and cons. Property is fantastic from a point of view that the bank will lend you a whole lot of money to go and buy it. So you need this much, the bank will give you this much, and then you can go and buy this great big house, whereas you can't do it quite so much in the share market.
Security there, yeah. I think part of it is too, like, I'm guessing the three of us have, really grown up in an era where the property market has more or less continued to go up and up and up. Like, it's quite extraordinary. If like my father was in this conversation, he's got obviously a couple more decades of life experience tacked on there. So, and, he'd be able to talk about more ups and downs in the property market. I mean, I can remember when I was quite young, sort of talking a bit about that, like, there were periods in the early 90s where property was crashing a bit, but then since then it's really continued to climb. So our generation and younger tends to think of property as being something that's inevitably just going to continue to go up, right?
So they both have their ups and downs. The bit around the share market and where that tends to people perceive it to be a little bit scarier is that we can make impulse decisions and act on those very quickly with the share market. So you could look at the share market today. I don't know if it's up, down, left, or right. I haven't looked at it, but you could open up the ASX website and see this sea of red. Everything's down 3-4%. You go, oh no, I better sell everything. And in that split second decision, you can just go in and sell everything and you're done. Yeah. Whereas you go home and you look at the news tonight and they say to you, Melbourne property prices went down 2% or 3% last quarter. Well, you can't quickly turn around and say, oh, gee, I better sell my house because the prices are going down. You have to find an agent. You have this marketing campaign. You've got this lead time. So there's time and the expense involved. Yeah. Whereas buying and selling shares is incredibly cheap and you can do it almost instantaneously. There's a price quoted each day, and people react on impulse a whole lot more with the share market than they do the property market.
Yeah, when I first started investing, I used to look at it not only every day, but probably multiple times during the day. And, I'd sort of call up the broker or call up my dad I was getting advice from and, lose my nerve very, very quickly. And then I don't do that anymore, actually. Like I probably look at it every day just in terms of like getting the daily news, but I'm not necessarily even looking at what shares and what companies I've got on a daily basis. And I'm not even sure how I got from A to B on that. I suspect that it wasn't sustainable to have that level of stress ultimately. But I imagine you have clients who are more hands-on than others. And
You do.
Does that change over time, do you find?
Yeah. So there's one client of mine that's been retired for many years. So he's been a client of the firm for a long time. I've been working with him for probably the last 7 or 8 years, and his longevity with the firm is far longer than that. It was a real nervous Nelly to begin with, and he'd be looking at things all the time. And so now when I have the meetings with him, he'll say, actually, James, I'm not even looking at it. I don't even care. Not that he cares, but he's not looking at it on a daily basis. He's just out living his life. And that's where we want to get people to say, don't worry so much about the day-to-day and the ups and downs. We want to get you in a position where you're out playing golf and you're with your grandkids and you're going on holidays and you're doing all of that fun stuff. Don't worry about the numbers and the ups and downs. That's my job. That's what you're paying me to do. You go and live your life.
Yeah, I would have thought as well. If someone simply just does not have the appetite for it, and they're always going to worry, even no matter how much advice they get, you'd almost be steering them away from it to say, look, if you're just going to have sleepless nights every time the stock market goes down a bit, then it's probably not the best kind of investment for your quality of life.
Absolutely. So we have there's a series of questions that we go through with everyone when we're getting down to the nitty gritty around making recommendations. All of those questions are more on the negative side. So what do you think your reaction might be if this happened, or if that happened, or if something else? Purposely, they're all negative, because generally people will take as much upside as possible. If I presented to someone and said, "Hey, you made 35% in the last year," they say, "Fantastic, James. That's amazing." But if I reported to them and said you went down 35% last year, well, that's when they're really going to start to panic. And so all of these questions that we have are on the negative side. And depending on how someone responds to that, we might say, look, without taking into account your attitudes on things, I think you should invest like this. But I need to take into account your attitudes, because the last thing that I want is for you not to be able to sleep, or you panic and sell everything at the wrong time, and then it's at a detriment to your finances. And so just because you are who you are, we need to invest a little bit more conservatively. Maybe just putting money in the bank account for now is the right thing to do.
James, I think it'd be fascinating as a study to look at those sorts of questions, because when you describe those questions to me, I'm thinking they're very similar to questions you would ask for a personality test or a test around trait anxiety. And people with high trait anxiety, no doubt, very high trait anxiety, are going to say to all those questions, yes, I would struggle with a lot of that. They don't like uncertainty.
Yep.
And so, I kind of suspect there is the profile of the person who is going to do a little bit better is going to be somebody who isn't necessarily a high risk taker who's going to blow all their money over silly things, but somebody who's not overly anxious and worried that they're going to fret and make the impulsive decision to basically just react to their emotion rather than the logic and the facts.
Yep, that's exactly right. Yep, that's what we see.
Now, I think we're probably almost out of time here, James. Really appreciate you coming in to talk with Cam and I today.
That's all right. Thank you for having me on.
Yeah, it's been really interesting. I think I think you're in a field which will never get boring for people. Especially, I imagine it's always been a topic of great interest to people who are actually trying to make financial decisions. But I think in recent times it's become at the forefront of a lot of people's minds after GFC, after things like COVID, and where people have seen this sort of vulnerability to something that we've kind of relied on to be quite strong in recent times. And so I think it's a really popular topic, and really, thanks for coming in to chat to us.
Right.
Thank you. Great chat.
Thanks for inviting me.
Awesome. All right. Thanks. We'll do the wrap up then. All right, Cam. Enjoyable discussion. I think, I learned a little bit more about you today as well. I might actually come and seek some share advice from you, Cam, as well.
I need to my dad, because that's where I get my advice from. But yeah, it's fairly conservative, long term stuff. Yeah.
Now I know you you've been a bit lazy and haven't prepared any wrap-up content for us
Putting
today.
me on the spot there. It's true.
Not,
Well,
not,
no,
nor did
I've been so hard working that I haven't had a chance to relax. Yeah. How about you?
Well, me neither. So we've both been extremely lazy in regards to our I was going to say content, podcast content. What I do, I have actually finished that book I mentioned last podcast, which is called Ant Kind. I think I mentioned.
Yes.
Yeah, that was.
That was the conclusion.
Oh, look, it's a pretty amazing book, but it's like if you any of Charlie Kaufman's writing or movies, it starts off being a bit kind of very comedic and a bit more down to earth, and then every chapter went by, it seemed to get more abstract and crazy, but towards the end. And just to give you an idea, there was a chapter where a Donald Trump character. Basically, it's in the story he's called Trunk, but it's supposed to be Trump.
Yeah.
He visits Disneyland and sees these robotic presidents in the theme ride, which is quite well known in Disneyland.
I've seen this. They have a hall of presidents or something.
Yeah, they have a hall of presidents, and he decides he wants to have his own lifelike version of himself that he can take back. The White House, because he's so amazed by this robot, and at one point there's an army of Donald Trump's fighting a corporation which is similar to McDonald's, and in the concluding chapters, so it goes from basically being fairly literal to being very surreal towards the end, and. Yeah, certainly, but a fantastic book. I think
I'll have to check it out. Actually, I do have two things to mention now comes to mind. There's a show I haven't seen yet, but it's about to be released. I'm planning to watch it. It's called The Mosquito Coast. So it's a TV adaptation of, it was a movie and a book back in the 80s. So from memory, the original movie was Harrison Ford. And the book was bought by Paul Theroux, and I've read the book and seen the movie, and it's a sort of a story. It's set in Massachusetts or somewhere like that, and it's about a father who's sort of sick of modern society and all its sort of vulgarities as he sees it, and decides he wants his family to get back to nature, and they end up going to Central America to kind of like start a new life in the jungle and kind of build almost like a little redoubt of civilization, in this swamp infested, mosquito infested swamp. And of course he goes quite mad in the course of that story. And it's partly the sort of unraveling of that, but it's an adventure tale as well. So I think a modern adaptation of that would be interesting to see. Another one that just came to mind, I have been watching a show called Solar Opposites, which is a cartoon made by the same people who made Rick and Morty. So
okay.
Rick and Morty, but Solar Opposites is it's somewhat similar in its sort of animation style, themes, and also voices. Like there's definitely some of the same actors in there playing character voices. It's probably a little bit more PG than Rick and Morty, but it's still probably not a cartoon for the kids. And it's I don't know, it's just got some very funny themes in there. Like there's one episode, the premise of it is these aliens escape from their home planet, which is a paradise, but it explodes randomly, and then they end up in Earth, and they're sort of like adapting to life in Earth, and they just live in the suburbs, and the alien status doesn't seem to be questioned by the people around them, but they're kind of trying to adapt. They also have all this remarkable technology that they're able to draw from, in their daily life, and it's quite fun.
So solar opposites, yeah.
Polar opposites, yeah.
Polar opposites.
Oh, solar.
Oh yeah, okay. So that's the pun. That sounds interesting for two reasons. One, I do like Rick and Morty, and also my business is called Opposite.
Yes.
So it appeals to me. So I will check it out. That sounds.
I think you'd enjoy it. Yeah. There's one great episode where they discover that their neighbor has a thing called a man cave, like a den where he hangs out and watches movies and stuff. And they think this is really cool. So they build one of their own, but then they discover they're not getting any enjoyment out of it. But then they realize that the reason that they're not getting enjoyment out of it is because they have no one to disapprove of it. Because this man, when he goes to his man cave, his wife disapproves of him spending time away from the family in the man cave. So they engineer a robot whose sole function is to disapprove of them being in the man cave. But then, of course, the robot ends up sort of like getting out of control and things escalate from there.
Yeah, that's really interesting. That's always like I remember doing philosophy back in undergraduate university, and I think there was these discussions around like if you were to, the reason why, like one of the arguments from philosophers is the reason why that there's pain is so that you can distinguish what pleasure would be.
Yeah.
And without pain, you have no point of reference. And I think basically that's the main concept, isn't it?
It's interesting. I heard a discussion recently about pain, and it was actually Dr. Carl, I think, on Triple J or something like that. And he was saying how there's maybe 3 or 4 known cases in the world of people who do not experience pain, like they just don't have the receptors or whatever it is. So that made me wonder, does that mean they don't experience pleasure, like physical pleasure? Like I don't know. I need to ask Dr. Carl, perhaps.
There is, I've certainly seen documentaries where it's absolutely catastrophic for people to not experience pain because they end up injuring themselves all the time.
Yeah, so it's a great warning sign, isn't it? It's sort of
especially when you're a child, where you don't. It's probably too a depressing note to try and end on, but certainly. Like how would you know? Like if you happen to be cooking and you had your hand on the hot plate, you wouldn't know.
Oh God, yeah. That's quite right, actually. Yeah. It's sort of like, I find as I get a little bit older, I experience hangovers sort of more than I used to, and I think you've told me you're the same. But I know some people who don't experience hangovers at all, and I think you're probably better off experiencing hangovers in a way because it's kind of your body's way of telling you, don't do this, and you moderate your behavior over time. But if you're sort of 50 or older and you don't experience any hangovers and you're still drinking like you were when you were 25 or younger, then that's probably the liver's copping all that hurt, isn't it?
Yeah, so long as you aren't experiencing the hangovers more intensely because you're drinking 10 times more than you.
Yeah.
All right. Well, I think that's a good place to end. The reminder of alcohol at the end of the day, at the end of the week, almost as well, which is a good reminder to enjoy our evening. And we'll catch you next time.
Thank you. Look forward to it.
See you again. Bye.